Alright, young millennials, let's handle it. Student loans. How do I pay it off? Okay. I know what you've been looking up, whether you should refinance, consolidate, get another loan to pay this loan, borrow from Peter to pay Paul. Okay, or maybe you've been told to, I don't know, pay more than the minimum payment. I wonder how that's working for you. Maybe you're being told to create a budget and minimalize and cut back and all this stuff. All right. I want to give you a new way. This is not as common. All right. It's using the velocity banking method. If you don't know what that is, please watch my other video on velocity banking. How to do it, what it is, what it means. All right. I'll explain it in a nutshell right here. The idea is to use other people's money or the bank's money to pay our expenses or acquire assets, and use our income to pay the debt right back. Okay. Another term for velocity banking is debt acceleration, right? But it's not the snowball method or the avalanche method or the Dave Ramsey method. No. This is the method that real estate investors, real estate developers, wealthy people use to kill bad debt and acquire good debt. So in this scenario, student loans, I'm talking to millennials right now, all right? And this is a really easy example of a student loan debt of $25,000 with $25,000 with a 10-year repayment period, interest 6.8%, minimum payment $280 a month. Okay, if you did the math, if you just did 280 times 10 years, that is what, 120 months. Okay, the number would come out to this. All right, minus that from the 25,000, the principal, and the bank profits 8,600. Okay, that's not actually 6.8%. It actually is 35%. Okay, so meanwhile, when you're trying to reconsolidate or refinance your student loans, all you're doing to try to save money over here on the minimum payment, all you're doing is resetting the clock on the interest. So maybe they'll tell you, yeah, well, we can save you 1 to 2% interest or something like that, or we'll save you $100 on your minimum payment. But when you actually do the math, all you're doing, you reset the clock, meaning you reset the payment term on the new loan that you got from a private lender or whatever, and they'll just take you for a ride. They'll probably make less than this, but they still took you for a ride. Okay, over here you're still gonna end up paying triple in interest. Alright, if you don't know how interest works, also watch my video on amortized interest and simple interest. Okay, so let's dive into this example right here. We have an individual, young person, right, just graduated college, has a bachelor's, okay, and they're making $3,000 a month, and their expenses are $2,200. They have that $25,000 student loan debt, and their cash flow is $800. Okay, and what I'm simply telling this individual to do is go get yourself a line of credit, a personal line of credit. Okay, they have from nonprofit banks, credit unions, some major banks do it, but it's a rare product actually. It's not as common as loans, right? And you have to know the difference between a line of credit and a loan. Okay, I'll have a video on that as well. All right. What I'm simply saying is get you a line of credit. for 10,000. Okay, it's not a big number. They go as high as 100,000. Okay, or even higher sometimes based on your net worth. Okay, and they're as low as like 3K or 5K. So I picked a small number, 10,000. Interest rate 12%. Let's just say random because you're just starting out in your credit world, so you're not exactly gonna get the lowest interest rate. And if you're thinking, Denzel, that doesn't make any sense. Why would I get more debt at a higher interest rate than my 6.8? Remember, you're not actually paying 6.8 on that 25K. You're paying that much. So you do the math. 12 or 35, which would you rather pay? Because this 12 actually means 12. Okay, 6.8, triple it in terms of amortized. This is a simple interest loan. Okay, and at 12%, remember what gets even better is you only pay interest on what you borrow. So here's the example. Is I'm telling this student, this graduate, to withdraw 7 grand, conservative, not the whole amount, 7 grand, and make a chunk payment on your student loan once a year, every single year for 3.5 years. This will be paid off. Okay, but how do I pay the 7 grand throughout the year? It doesn't make sense. I'm getting more debt to pay this debt. It sounds like I'm borrowing from Peter to pay Paul. Okay, but in this scenario, when I borrowed from Peter didn't charge me any interest, number one. And number two, I save money on the entirety of the amount, which would increase my cash flow. Alright? So, here we have, recap it. This $3,000 right here that this individual is making per month, instead of living this way, where he or she gets a paycheck, they pay their bills or expenses, and they have money left over, and they go spend it and do whatever it is we young people do, right? In that sense, I'm just making a small tweak. I'm not asking you to go on a ramen noodle diet. I'm not asking you to sell all your clothes and sell all your shit, which is sometimes a good idea, but I'm not telling you to do that, okay? I'm simply saying, we withdrew 7. I made a chunk payment on the 25K. Immediately what happens to that specific debt is you cut this interest damn near in half. Okay, because the way interest works on that student loan debt is they're front loading all the interest on that 280 every single month. So your 280 is not actually going towards the principal. But when you make a chunk payment of a big amount, like 7 grand, okay, you lower the balance, you lower the interest, and you satisfy that month's payment. Make sense? Okay. Part 2 is you just created a debt of 7 grand. Whatever the minimum payment is, alright? We don't care what the minimum payment is. Why? Because we're actually going to dump our $3,000 that we make per month, right? So if you're getting paid bi-weekly, okay, $1,500 paychecks, or every week, whatever that number comes out to, okay, before you even pay a bill or buy anything, I'm simply saying dump everything into the line of credit, which would cancel out any interest accruing on this debt. It would cancel it out. Okay? What's going to happen now is you're like, well, we have to solve for this. How do I pay my expenses, Denzel, if you just told me to dump all my money into a line of credit? The beautiful thing with lines of credit is that it's flexible, okay? It's revolving. When you put the money in, you can take it out immediately, okay? So all we're gonna do is we put 3 grand in, so now the balance is at around 4,000, okay? lowered the balance on that, canceled out the interest on that, satisfied the month's payment. It also satisfies 2 to 3 months payments down the road, right? But you have your expenses for the month. So how do you pay that? I'm simply saying you withdraw money again out of the line of credit into your checking account, and then would you pay your bill. So if you have a $400 payment on your car on the 10th, okay, and then your phone bill's on the 15th, I'm not telling you to withdraw $2,200 all at once. You're just going to withdraw money as you need to pay your bills throughout the month. But what's happening is as you're withdrawing to pay your bills throughout the month, what else is happening? You're also getting paid every week or every 2 weeks. So what are you going to do? You dump that money right back in. And what remains in the line of credit is this part right here, your cash flow, your money left over after every single month. The money that doesn't go anywhere. Maybe you're stuffing it in your drawer, in your savings account, in your retirement account, okay? Redirect all that money back to you. Take it out of your drawer, take it out of the savings account, dump it into the line of credit. Everything. Boom. And you're only going to withdraw your living expenses, whatever it is that you pay for throughout the month. In this example, this person has $2,200 in expenses, so they cash flow about $8. Okay, if you do the math, 800 times 12 is what? It's 9,600. We only took out 7. So technically, this loan will be paid off within a year. Okay, so what are we gonna do once this comes back up to 10K? Right? We originally took out 7. We made a chunk payment on the student loan. Okay, we used our income to pay the line of credit, and we withdrew to pay our expenses. And throughout those 10 months or so, all we're doing is dumping money in, taking money out. Right? We keep paying our student loan payment, the $280. Right? The $280 is coming out of the $22. Right? So nothing changed. I didn't add an expense to it, because when you dump $3,000 into this line of credit, right, you're having your money work in 2 places. Right? You used the money twice. You got paid, dumped it into the line of credit, and then you took it out again to pay the rest of your expenses. I hope that makes sense. All right? So after we made that first chunk, in 10 to 12 months, the balance is going to come back up to 10. What are we going to do? We're going to take another 7K out and make another chunk payment. Okay? And you do it again. When you do the math, 7, 14, 21, and then you do it for the remainder balance. Maybe it's like $3,000, $4,000 left. 3.5 years to pay off a $25,000 student loan debt. Okay? You can do the math on how much money you would save on interest alone. On interest alone, you're saving thousands on the interest alone. Your cash flow is going to go up $280 after 3.5 years. Now, 3.5 years sounds a lot better than 10. To tell you the truth, that's a third that we're killing debt. So before you even qualify to refinance or consolidate, usually you gotta have the loan for like a couple years or so, because it's based on your work history, credit history, all that stuff. Right? So before you even consider refinancing, consolidating, I'm not saying they're bad things. I don't think they're as effective. Okay, and what happens when you don't understand how refinancing work, how consolidation works, it can bite you in the ass. Okay, you can end up paying more money. This is what your mom and dad goes through when they refinance their home mortgage after 5 years. They don't even realize that they lost all the equity in their home when they refinanced. They don't even realize that. They're thinking, how can I save money on the monthly payment? Their head is twisted. Okay? I don't want your head to get twisted like that. All right? We got to be better. Okay? We're millennials. Okay? We have to improve. All right? Mom and dad effed up, which is why they're still working into their 40s and 50s, right? And you're over here with this massive debt, figuring out, like, what the hell do I do? All right? I'm here to help. So look, 3.5 years, paid it off. My cash flow goes up to 280. Now it's at 1080. Okay? And you now have a $10,000 line of credit available to do what with? Maybe you can kill off the car that you have, maybe another expense, a high interest credit card. Okay, this is what velocity banking is teaching people, is simply using the bank's money to pay other debt, bad debt. Student loan is a bad debt. A mortgage is a bad debt. A car finance, auto loan is a bad debt. A good debt is personal lines of credit, business lines of credit, credit cards with 0 interest on it, promotions. Any type of credit that's gonna make you money is good debt. So we're using debt to pay debt, and we make money in the process. Okay, I didn't tell you to work extra hours. I didn't tell you to go on a diet, okay, and sell all your stuff and, you know, get 2 jobs. Using your own income, we acquired good debt to pay the bad debt. In the process, I saved money on interest, and I also increased my cash flow, which everybody needs to do, right? So how do I increase my cash flow? How do I not lose my cash flow when paying debts? Because what you've been told is to pay more than the minimum payment, but that doesn't do anything. All that does is pay down the debt. We want to pay off the debt so that we can get ahead and move forward with our career, right? And find that place to live and find that business to start, right? 3.5 years is a lot better than 10. Okay, get it? Velocity banking. Do it. It's going to save your life, all right? It's going to save you a lot of money, and it's going to make you money using your own income. I like that. All right? I'm going to do more examples to help people, because some people got like 70 grand, you know, and they're like, dude, 25? What the fuck? Like, if you have 75 grand, you better be making more than 3 grand a month, okay? And if you're not, you're fucked, okay? But that's not too bad, all right? You know, you got all this debt, 70, you know, 80, 90 grand. I hope you got the career that your degree says you should have, all right? If not, okay, you need to reach out to me, and let's put a plan together on how we're gonna create income, okay, to kill that, because that's no good. All right, you're gonna be there a while. That's 70 grand or 80 grand. That's usually more than 10 years. It's probably like a 20, 25 year repayment period. All right, so I'll do an example on that for you guys as well. But for like smaller debts, like that, and 25 is not small either. Like there really is no small student loan debt. They're all big as fuck. But yeah, I hope you enjoyed that. Please grasp that. Do your research. Do your homework. Okay, before you refinance, before you consolidate, consider this strategy right here. Okay, I can save you and make you more money than that refinance option can. Okay, put my name on that.